Hello macroeconomics students. This week we're going to be looking at Lesson 5, Chapter 10, Measuring a Nation's Income. And so in this chapter we're going to be looking at this very important concept of gross domestic product. We'll refer to it as GDP. We'll look at how it's related to a nation's total income, the components of GDP, how we adjust it for inflation, how it measures society's well-being. So we're going to start with a look at micro versus macro. This is an important concept. Microeconomics, as most of you know because you already took the course, is the study of individual units, small units in the economy. So individual households and firms, sometimes industries, but generally small units of decision making in the economy. Macroeconomics deals with the economy as a whole, so larger institutional organizations. So when we start looking at gross domestic product, we look at this concept of income and expenditure. And when we talk about GDP, we actually use it to describe the same thing. The assumption is that income and expenditures are the same because every dollar that a buyer spends is a dollar of income for the seller. And we use that to describe all of the components of GDP, and you're going to see that in a moment. We're going to start with a look at this diagram that you may have been introduced to before, the circular flow diagram. The circular flow diagram is a really great, simple depiction of the entire economy, and it shows how GDP is spending, revenue, factor payments, and income. So to understand the circular flow diagram, you have to first understand the factors of production: land, labor, capital, entrepreneurship. Those are our basic productive resources. And in the circular flow diagram, there's a market for those things. Payments for those things in that market are payments to the factors of production. So when you see the diagram, you'll see that the payment to labor is wages. The payment to land is called rent. The payment to capital is called interest. And the payment to entrepreneurship is called profit. So when we see these factor payments, we'll see that those are the payments to the different factors of production. So the diagram looks something like this. You've got your two groups in the economy, your households and your firms or businesses. And the households are the owners of the factors of production. So what you should already know from your micro class is that in a private or market economy, households are the individuals that own the factors of production, the land, the labor, the capital. And they sell or rent them to firms to earn income. And the buyers are also part of the households. They're the consumers of goods and services. So that's the role of the households, to sell or rent the factors of production and to buy and consume goods and services. On the other side of it, you've got another group in the economy called the firms. The firms, of course, are your entrepreneurs. They take a risk, they seek a profit, and they combine resources. So firms then are hiring factors of production, and they use those factors of production by putting them together in different ways to produce a product. And then, of course, the other role of firms is to sell those products that they produce. In between, of course, these groups are some markets. So in the market for factors of production, land, labor, capital, you can see that the households, who are the owners of those resources, take them to the market, exchange them with the firms, and when they exchange it, you can see this green line is the money flowing to the households. That's income that they earn. Well, in the macro picture that we're looking at, we call that GDP, national income. Look at the other side of this. As those factors of production flow to the firms, firms, of course, are spending money on those, and the money spent, depending on the factor of production, is going to be wage, rent, interest, or profit. And again, those expenditures are also GDP. And the assumption for this model, and in general, is that those expenditures are going to be equal to the income earned. So when we measure GDP, we can take either an expenditures approach or an income approach. And either one's going to give us the same amount of money, the same value anyway. So we have the other market in this situation, the market for goods and services. Since it's a circular flow, we can see that households, when they earn that income right here through GDP, they take it out there and they spend it. They buy goods and services. And when the money is spent, the revenue earned by firms, of course, comes back to them as dollars in the door. And again, we have the same sort of relationship here. Revenue is money earned, that's income. Expenditures are money spent, that's expenditures. So again, we have the exact same understanding that every dollar that exists as an expenditure is received as income. And so in the circular flow model, we can see that in both markets, that every dollar spent is a dollar of income received. So what this diagram doesn't show us is the role of the government. The role of the government, of course, is to collect taxes, and they also go into both markets. They buy goods and services, they buy resources. And so that's an important part of it. We don't ignore it altogether, but we do leave it out of this diagram for the sake of simplicity. The financial system, of course, is another thing that's omitted from the diagram. And the financial system is one that matches savers with borrowers. And we'll talk about that later in this course. And as you can see, the diagram itself assumes that every dollar is spent. And some of you, of course, naturally understood that not every dollar is spent. Every dollar is either spent or saved. That's another assumption we'll come to later in the course. And so from this diagram, we don't see that role, the financial system. And the third thing that is omitted from this particular diagram is the foreign sector, the idea that we trade with outside nations. So that's an important thing to understand about the circular flow diagram. It's a useful diagram. It shows us something important about expenditures and income, but it does leave out three very significant things that we will look at later. So let's just define the concept of GDP, gross domestic product. Here's our definition of it. It's the market value denominated in dollars of all final goods and services produced within a country in a year, a given period of time. And the given period of time, of course, is 1 year. Goods are valued at their market prices, so we denominate everything in the same units, which in the U.S. would be the dollar. And that's an important thing to understand because we don't evaluate them based on subjective prices. We use the objective measure of the market price. So things that don't have a market value are going to be excluded. Things like housework that you do for yourself, meals that you prepare for your family. Even though they have value to you, that's a subjective value. So only things that can be objectively valued and denominated in dollars are going to be counted in GDP. The second part of this, final goods, is an important thing to understand. Final goods are goods intended for the end user. So that would exclude, by definition, intermediate goods. Intermediate goods would be the component parts or the ingredients used in the production of other goods. So it would be, if I'm building a house, the final good is the house. The intermediate goods would be the lumber and the shingles and all of the plumbing materials and, gosh, so many things. So the market value of final goods and services, this is going to be really important because that's all that's counted in GDP. They already embody all of the value of the intermediate goods within them. And GDP is for goods and services. This is another important distinction. It's not just goods, tangible goods, but it's also intangible services. Those are included because they have value. They're produced using resources and they have value. And it has to be only currently produced within the time that is allotted for it. And so it's currently produced, so not used goods, nothing produced in previous years, produced within that year that we're measuring it. And of course within the country's borders, whether it is done by citizens or foreigners located there. That's another important thing to understand. So if Toyota, which is a Japanese company, has a factory in the United States and they're producing cars, those cars would be counted in the United States GDP. And that's an important thing to understand. Now, American companies that are producing outside of the United States, they're not included. It's only within the country's borders. So in GDP, a very specific concept. And of course, the final thing is the given period of time. And it's usually a year or a quarter of a year. But typically we look at GDP as an annual measure, although you will see quarterly measures used to compare within a year. The components of GDP are pretty important to know. So it's going to be really important that you know this identity for GDP. So there are 4 components: consumption, investment, government purchases, and net exports. And you can see the designation for each one of those. When we put it together, we get this nifty identity or equation, and Y is the term we use to denote GDP, is equal to all of those components added together. So when we're measuring GDP, we look at consumer spending or consumption. We look at investment spending, which has a very specific definition. We look at government purchases, not government spending. There's a big difference there. And we look at net exports. So let's look at each one individually. Consumption is what it sounds like. It's households consuming goods and services. And it represents the largest portion of GDP. By far, generally about 70% of GDP can be explained by consumption behavior. And so obviously when a policy needs to target something to raise GDP, they're going to always go to the consumption sector first. On housing costs, it's important to note that renters include the rent payments in their consumption measurement. And for homeowners, consumption includes the imputed rental value of the house, which is an interesting way of looking at it. Not the purchase price, but what it would earn in income. Remember, consumption and income. So spending and income have to balance one another. So for homeowners, it's kind of this interesting way that it's measured as consumption, because it's not the purchase price, it's the imputed value of what it would rent for. Investment, another very specific concept in economics. It's total spending on goods that will be used in the future to produce more goods, which what by definition would be capital goods. And this is going to be spending by businesses. Almost exclusively, investment is spending by businesses on the capital goods that will allow them to produce and sell more in the future. So this is going to be capital equipment, structures, inventories, things like that. Now, one note about structures, you'll notice that houses is included in that. And in the investment category, brand new houses, houses built within the year that GDP is being measured, will be counted in investment. Houses that are resold will not be. That's why you saw houses in the consumption sector as, once they have existed past that year that they're measured in, then the imputed value of rental is given. But new housing built in the year of measurement is counted in the investment category. And so it's an important note that the text gives you here that tells you that investment doesn't mean what we kind of traditionally think it does, which is the purchase of financial instruments, but rather it is the spending of businesses on capital and the things that are going to make the business grow. Important distinction. The third component, government purchases, is spending by the government on goods and services. So it's really important to know that it's actual purchases made by the government. And it doesn't have to be a tangible good, it can be a service, but it is a purchase made. So it does not include things like transfer payments. So that's why we distinguish between government spending and government purchases. Very different thing. Only the purchases are counted in GDP. And it excludes then, by definition, Social Security, unemployment insurance, anything that is a transfer payment. Because those payments are not purchases of goods and services. Nothing is produced or purchased in that exchange. Net exports is the last component, and that is the net exports minus imports. So exports, of course, are foreign spending on what we produce, and imports are what we spend on foreign goods. And so net exports are counted in our GDP. And so that's how we get our equation. Again, GDP is equal to consumption, investment, government purchases, and net exports combined. This gives you a nice little look at how the components break down in terms of how much percentage each one makes up of the GDP total. So here's in 2013, total GDP was 16,912 billion. It's measured in billions. And the consumption portion of that was 68.2, so pretty close to that 70% measure. Investment was 16%, government purchases 18%, and net exports, this represents that trade deficit we've had for quite a few years now, were a negative on the economy. So net exports, that trade deficit, was actually a drain on GDP and actually brought our GDP down. And the total then is reduced, of course, by that $500 billion in net exports that we lost. So here's an opportunity to practice a little bit and recognize the components of GDP. And this is going to be a really helpful and important thing to know as you look at this chapter of study. So they give you some cases to determine how much GDP is affected and how much each of its component parts is affected, if it's affected at all. So you've got Debbie spends $300 to buy her husband dinner. Sarah spends $1,200 on a new laptop. Jane spends $800 on a computer. And General Motors builds $500 million worth of cars. My advice to you would be, before you look at the answers and continue on with the video, is go ahead and see how you do with it. Work through each of these, see if they fit in with each of those 4 components of GDP, and see what effect they would have on it, and then check your answers. So here we go. Debbie spends $300 to buy her husband dinner at the finest restaurant in Boston. And here we can see that that expenditure is going to cause GDP to rise by $300 because the consumption component is increased by $300. And that's purely consumption. Sarah spends $1,200 on a new laptop to use in her publishing business. The laptop was built in China. So this one's a little bit tricky because investment rises by $1,200, right? We can see that. She used it to use in her business, but the net exports fall by $1,200 because the laptop was built in China, which means it was an import. And if net exports are exports minus imports, then you have a negative $1,200 in the net exports category, which offsets the $1,200 in investment, leaving GDP unchanged. Jane spends $800 on a computer to use in her editing business. She got last year's model on sale for a great price from a local manufacturer. Well, she spent $800, but she bought something that was purchased in a previous year. So it's only spending or consumption if it is on goods that were produced within the current year. So current GDP and investment do not change. And finally, General Motors builds $500 million worth of cars, but consumers only buy 470 million of them. Well, consumption rises by 470 million. We can see that pretty easily. But the 30 million that's left over still was produced. It goes into inventory, and that is counted in the investment category. So GDP rises by the full 500 million, even though consumption is a portion of it and investment is a portion of it. The next concept is to understand real versus nominal GDP, a very important thing. Inflation can really distort economic variables like GDP. So if we're measuring gross domestic product from one year to the next, we all know that they have different prices sometimes. Goods from one year to the next will have a different price. And so we're going to get 2 different numbers, and it's going to look like perhaps GDP rose when all that happened was the price of the goods rose. So it doesn't really tell us a true story about our output. So for example, if we produce 10 apples in one year and each apple costs $1, and the next year we still produce 10 apples, but now each one costs $2, we'd say GDP in one year was $10, GDP in the second year was $20, and we might say, gosh, we had 100% growth in GDP. But that's not what happened at all. Our production did not rise. Rather, the cost of it rose, the price rose. And so that distortion due to inflation can really give us incorrect information. So we want to understand the difference between nominal GDP and real GDP, which takes away the effects of inflation so we can look more accurately at the results. So nominal GDP then is the values using current prices. And it's not corrected for inflation. Very easy to understand. It is simply price times quantity on its face. Real GDP, however, is the values using the prices of some given base year. And with that, we're able to correct for inflation and take inflation out of it to get a true picture of what is really an increase or even a decrease in GDP. But we can get a picture of the real change in what we're actually producing. So here we have a really good example, and they ask us to calculate the nominal GDP in each year. Well, all we do is take the price times the quantity of each of the two goods, and the assumption here is that this economy is only producing pizza and lattes. And we can see pretty easily that in 2011, 10 times 400 is going to give us 4,000. $2 times 1,000 is going to give us 2,000. So for the year 2011, the total GDP then would be 6,000. And that would be nominal GDP. In 2012, we do the same process. We multiply price times quantity. We add the two together. We can see that GDP, nominal GDP, is 8250. And in 2013, again, we have different quantities, different prices. So we can calculate GDP in 2013. The problem, I'm sure you can see it already, is that we don't really have a way of seeing whether the economy is growing, shrinking, improving, getting worse, because the numbers themselves tell us too many things. We have price changes in there, we have quantity changes, and what we really want to do is take the price change out and see, are we growing? Are we producing more? So if we measure the increase using just nominal GDP from 2011 to 2012, we'd say, gosh, the economy grew by 37.5%. And then, of course, if we went from 2012 to 2013, we would see a 30.9% increase. This number seems useful on its surface, but it really overstates the changes. So to get a more accurate number, let's find the real GDP. And if we use 2011 as the base year, here's how we do it. We look at the price in 2011 and we hold it constant. And that's the trick. Whenever we have a base year, we hold prices constant. So that as we measure the changes out into the future, all we're going to see is the change in production. We're going to see the change in quantity and what that means. So we go with the same calculation for the base year of 2011. Then 2012, notice that we hold the price constant. Now, still in 2012, more were produced, so 500 produced instead of 400. And with lattes, the price is held constant at $2, but we recognize the increase in quantity. So when we calculate in 2012, based on the prices of 2011, we get 7,200 as our adjusted GDP. We do the same thing for 2013. We measure the quantities produced in 2013 at our base year price. This takes price changes out of it and lets us evaluate the changes without seeing price changes. Basically, it's called deflating. It takes the inflation out of it. And what we can see here is now we get a much more accurate measure. When we look at the increase in real GDP from one year to the next, we see that it's only 20%, not 36% change. And from 2012 to 2013, it's 16.7%. And what we see in this increase, this number now tells us that we increased our production. We've taken inflation out of it. We're not looking at that. And now we're looking at a 20% increase in production from one year to the next. And for this 2012 to 2013, a 16.7% increase in production. And now, since we're measuring gross domestic product, it gives us a much more useful and accurate figure. To recap the difference between nominal and real GDP, what we can see is that in each year, Nominal GDP is measured using current prices, meaning prices for that year. Real GDP is measured using constant prices from the base year. In this example, it was the base year of 2011. We can see that the original change in nominal GDP really overstated the changes because it included the factors of inflation. And real GDP gave us a much more accurate measure that got a lot more close to the actual value. What we see from this is that the change in real GDP is the amount that GDP would have changed if prices were constant. And it goes back to that idea that it gives us an increase in actual production rather than measuring inflation in there with it. So GDP then, by definition, is corrected for inflation. Here you have a graphic that shows how GDP and nominal GDP move in essentially the same direction over the years. The GDP deflator is the measure of the overall level of prices. It's sometimes known as the GDP price index, and it's a way that we can pull out inflation from GDP measures and get a rate of inflation from it. So our definition then is the GDP deflator is equal to 100 times the nominal GDP over real GDP. For those of you that are preparing note cards for exams, I would definitely have this information on a note card, because rather than trying to memorize a formula like this, I think it's helpful to have that in front of you so you can focus on understanding how we apply it, not what it is. The way to measure the economy's inflation rate is to find the percentage increase from one year to the next using the GDP deflator from one year to the next. So we're going to see how that's done. So here's a good example of this. We can calculate the GDP deflator in each year using what you just saw, that formula, and we can see that the GDP deflator in the base year is always going to be 100, because if you remember the formula, it was nominal over real. So nominal over real, well, in the base year, nominal and real are the same, so it's going to be 1 times 100, and so you're going to have a GDP deflator of 100 in the base year, and that's always going to be the case. For 2012, we can take nominal over real, 8250 divided by 7200, multiply the result by 100, and we get a GDP deflator of 114.6. And the same for 2013. We can take the nominal, divide it by the real, multiply by 100, get 128.6. From this information, we can see that the rate of change can easily be measured from one time period to the next. And what we're measuring here is the change in the GDP deflator. So it becomes pretty useful. We can take the next time period and analyze the result from the change from 2012 to 2013, and we can do that and get 12.2%. By the way, if you are wondering how to do percentage change, here's another formula you might want to put on your note card. It makes life very, very easy. The formula for percent change is always new minus old over old times 100. So if you're looking at this, we have new minus old, right? So let's do 2011 to 2012. New information, well, time period 2 is 114.6, minus old, which was 100, over old. The result multiplied by 100 is going to give you that 14.6%. And you can do that with any of these. And if it's a negative number, you'll get a negative out of it. But it's a great thing to know. It's a very valuable piece of information. And anytime you have to calculate a percent change, new minus old over old, multiply the result by 100, or move the decimal over 2 places. Either way, you're going to get the right answer. Another opportunity to practice computing GDP, and they want you to use the information given to solve some problems. So the first one is compute nominal GDP in 2011 and compute real GDP in 2012. And they tell you that 2011 is the base year. So nominal GDP, of course, is going to be price times quantity, and that's going to be in current year prices. So pretty manageable. Oh, by the way, Part C asks you to compute the GDP deflator in 2013. So here we go. We'll go through all that. Find the nominal GDP in 2011. We're going to do price times quantity, add those up, and we're going to get 46,200. Pretty basic. B, to find real GDP in 2012. Remember, we're going to use our base year prices. And so we're going to say it's going to be 30 times 1,000, right? Because we look at the new quantities, but we hold the prices constant. And we're going to use our base year price here. So 100 times 200. So our real GDP is going to be 50,000 for 2012. And then if we want to calculate the GDP deflator in 2013, remember we're going to go nominal over real times 100. Well, we can find the nominal by doing the multiplication and add, right? Price times quantity. So 36 times 150, and then 100 times 205 gives us our nominal of 58,300. We can do our real by using our base prices. So we can do 30 times 1050 and same base price, so 100 times 205. That's going to be our real. So it's going to be 52,000. Then to do our GDP deflator, we're going to put our nominal over our real, multiplied by 100, and that's going to give us 112.1. Now the next part of this is going to ask you to understand the rate of inflation from one year to the next. So if we knew the GDP deflator in 2012, we could go from 2012 to 2013, we could measure the change in the GDP deflator. But since we don't have that, we won't worry about it. But you could figure that out if you feel like you want to take that extra step. To understand GDP and how it relates to our economic well-being, we usually use the measure of GDP per capita or per person. And for most nations, it's the primary indicator of how we're doing and how our standard of living is going. It's not a perfect measure of well-being, but generally we use that per capita measure to tell us how well each individual within the economy is doing. Robert Kennedy is pretty famous for issuing a really eloquent criticism of GDP, and here's what he had to say about it. He said that it does not allow for the health of our children, the quality of their education, or the joy of their play. So he says it undercounts pretty dramatically. It does not include the beauty of our poetry or the strength of our marriages, the intelligence of our public debate, or the integrity of our public officials, again, undercounting it. It measures neither our courage, nor our wisdom, nor our devotion to our country. It measures everything, in short, except that which makes life worthwhile, and it can tell us everything about America except why we are proud that we are Americans. Now, if you want to see that, I recommend you go to the YouTube video where he goes a little further and points out that it also overcounts things that really detract from our well-being. And it's well said, and he points out that GDP is not a perfect measure. It misses a lot. So it does not value the quality of the environment. It does not account for leisure time. I think we'd all agree that from our parents' generation to now, our leisure time has been much improved by the advancement of lots and lots of new technologies. And GDP doesn't count that. It doesn't count the quality of life that we enjoy because we have more communication or more access to things. It doesn't value non-market activities such as childcare that you might provide at home, or the meals you might provide, or all of the benefits of that sort of thing. It doesn't value equitable distribution of income. And so you might ask yourself, well, why do we care about it? Why do we measure it at all if it misses so much? But it does provide us with some really valuable information. Having a large GDP enables a country to better afford the things that matter to them. It also gives us a good measure for how to compare to other countries. It gives us indicators of quality of life that are positively correlated with GDP. And so you can see that when you look at GDP per person, I really like this graphic because you can look at Germany, the US, and Japan out here with high GDP per capita in the close to $50,000 per person range, and then compare it with a country like Bangladesh or Nigeria. And we can see very clearly that we have a much higher standard of living. We enjoy much more comfort in our lives. And this particular graph relates to life expectancy in a number of countries. This shows us that the US, Germany, Japan, being more advanced economically, enjoy a much longer life expectancy than the lives in the poorest countries. And so it gives us some really good information. This one refers to average schooling. And again, we can see the correlation between GDP and the measures which are important. So education, life expectancy, all of these things have value to people. Water quality, another thing that has tremendous value. And you can see that the higher GDP has much more access to clean water, safe water, a very important thing. To summarize the chapter, GDP is the measurement of a country's total income and expenditure. Remember that circular flow model where one is the same as the other. The four components of GDP are consumption, investment, government purchases, and net exports. Nominal GDP is what we measure in current prices. Real GDP is the adjusted prices, adjusting for inflation. And GDP is the main indicator of a country's well-being, not a perfect indicator. Okay, that's the end of Chapter 10. Next week, we'll be looking at Lesson 6, Chapter 11, looking at the concept of inflation a little more deeply.